Hi, welcome to the Toronto Real Estate Podcast. Today, we are going to take a look at the data, the raw data, so that we can see where we're at in the market relative to what has transpired over the last couple of years so that we can have true context. There is so much fear and uncertainty right now purported by the media. I think it's really important to just understand what the facts are so that you yourself, as you're watching this, can make your own determination as to what is the best course of action for yourself. My name is Ralph Fox, and I am the co-founder and broker of record of Fox Marin. And today we have the fabulous co-founder of Fox Marin, Kori Marin, joining us today. Hi, Kori.
Oh, hi, Ralph. I love your introductions. I actually jumped off my seat when you said hi because it was so animated.
Well, you keep telling me I need energy.
I know. You do need energy, especially at this time of day. I don't know what time everyone's watching, but some people have reported that they watched at 3 a.m. So energy is always required. Well, I'm so happy that we're talking about this. And this sort of came to fruition as both of us were discussing the fact that we're anticipating some interest rate cuts coming this fall. How is the market responding to the interest rate cuts that we have seen? And we really wanted to take a deeper dive in terms of the influence of interest rates with prices and activity, and then roll back to when this all started. So we are going to pull up some data on the screen for you. And I want our viewership to understand that this is done all manually. It's not like Ralph and I can jump into MLS and then pull down a graph or pull down a chart. We actually have to manually pull all of these numbers together to create this statistical viewpoint. So it takes a little bit of time to dissect it. So that's one thing and one caveat. And I also just want to acknowledge that we can't look at every single economic factor in every single slide. And we're totally acknowledging that as well before we get some comments in the comment window about that. Of course, there's so many things influencing the market beyond just the data points that we're pulling up here. This is one snapshot, one perspective, one way of looking at it. And of course, there's so many other layers. So I'm just putting that all out there for you right now.
And the last thing I would like to put out there, based on some of the comments that we get on some of our content, is we're just reporting data. And there is no grand conspiracy amongst realtors to necessarily pump the market. Most agents who are experienced and who do a significant amount of transactions really would prefer a balanced market condition, because those are the best opportunities for great agents to shine, and they really present opportunities for both buyers and sellers to win. We don't want to espouse a hockey stick straight up forever. It's not the case. We're not saying that it's the case, nor do we expect it to be the case, at least for the next 2 to 3 years.
And I would just like to say one more thing before we jump into the data, is that we actually love everybody's point of view. And I really would love this community to be able to feel free to have their perspective and disagree with us. And we're totally okay with that. You don't have to always align with our perspective. And we welcome different opinions, and we love that. And we appreciate it and support it. So I just want everyone to freely feel like they can also express that too, and that we respect that so much. Okay.
And I also feel that people get really disappointed when we present data, and the data really is that we're not all going to die, and there isn't going to be a zombie apocalypse in the Toronto real estate, because quite frankly, there isn't. Now, there may be ups and downs, but there's no coming apocalypse where values are going to go down by, 90%, which is what some people I think are hoping for.
Yeah,
who try to tune
understandably in some regard. So, okay, so let's look at this. So this is a little bit of a mouthful. And so when we open up the slide here for you, don't stress when you look at this, because you're going to be like, oh my God, what is this? And I don't understand it. We're going to highlight certain things on this for you to, again, gain a perspective on what's been happening since these interest rates have started climbing. So this particular slide that we're looking at here is detached homes in the 416. And what we're looking at in this table that we created is the average price of detached homes versus the interest rate change by month. So we don't have every single month highlighted here since January 2022. We're just highlighting the months where there's been an interest rate change. So that's my first caveat. So we're basically looking at January 2022 to July 2024. And here in this table, what we've highlighted here is basically the height of the market. What is the maximum average price that consumers were getting for their detached homes? And that's highlighted in yellow here. And that happened in the height of the market in approximately February, March of 2022, when the average detached home was selling just for over $2 million. And then the average height of the transactions or deals going through the system, so the most amount of detached homes sold per month, took place in March 2022, which is highlighted in yellow. Now, as you go across in this table, you can see what the prime rate was. So in the height of the market, the prime rate, I know these were the golden years when money was cheap. 2.45% and 2.7% was the prime rate. Okay. So that's the environment where this height of the market was taking place. And then we're comparing that to where the lowest average detached sale took place, or overall, was in January 2023, when the average detached home was selling for $1.48 million. When the interest rate of the prime rate was at 6.7%, totally acknowledging, viewers, that January is already a slower month and just a little bit frumpy in the market in Toronto due to being post-holiday and also gross weather and not really a lot of amazing product comes out. So completely acknowledging that, but just want to showcase that in comparison to what the prime rate was. Anything else you want to add to this description of what the table means, Ralph?
No, I think you're doing a great job.
Okay, amazing. So here on the right-hand side, I just want to highlight a few other things were layered into this. So throughout all this frenzy insanity, we also added in 2021 the new vacant home tax. Then we added the new foreign buyers ban in January 2023. Then we added the new anti-flipping rule in January 2023 as well. Then we layer in the new luxury land transfer tax January 1st of this year. And then we just also added the new increased capital gains tax in June of this year. So beyond all these interest rate effery, we've also had all this tax effery happening as well.
We also had property taxes rise by 9% this year, in addition to the vacancy tax increasing, I think, from 1% to 3%. So
a lot of that jazz going on, okay?
Yeah.
So I want people to also sort of see the big picture. So if you purchased a home in the height of the market, where do you stand today? So if you purchased in that prime time when money was cheap, so that February, March 2022, and you bought a detached home, yes, prices have come down. In fact, they've decreased about 20% year to date compared to the height of the market. And there's actually 45 less transactions compared to that period compared to July 2024. However, if you purchased a detached home 5 years ago, so July 2019, prices are up 34%. And if you purchased a detached home a decade ago, similar to the podcast that we did before, where we looked at the last 10 years of real estate, prices are up 87%. So depending on when you purchased, this is the best way to think about your asset today. So of course, if you purchased in the height, you probably wouldn't want to sell tomorrow because you will 100% be losing money. Right, Ralph?
Correct, Kori.
Okay. So then we were like, okay, so we're definitely not at the height. We all know this. We're not telling you anything, viewers, that you don't already know. We're not at the height of the market. I know, shocking news. We've taken this.
But the question is it really that bad?
Is it really that bad? And how long will it take to recover? So we've already seen 2 interest rate cuts, and we're expecting 1 or 2 more come the fall. So we're already on a better trajectory. We're already seeing prices bouncing back slightly since the low point of the market in terms of that red section in the table here. And we're like, well, how long will it take to bounce back or recover to the height of the market? So we took a very conservative approach and we're like, let's just say properties start increasing or appreciating at 5% a year.
Which is half of the average of the real estate appreciation, I think, over the last 20 years.
Yeah. just like a nice conservative approach, interest rates are coming down, what would that look like? So at 5% growth per year, it would take 4 years to bounce back to the peak of the market, which I feel is very palatable. Like that doesn't make me nervous. It's not like it's 10 years or 15 years, it's 4 years and likely faster than that if you consider everything else, including immigration. Anything else you want to add to that?
No.
Okay. So then we were like, it'd be really just interesting to compare what would it look like if you purchased at the peak of the market when prices were at the highest, but at the lowest interest rate, compared to purchasing at the low point of the market when interest rates had peaked. So we're kind of comparing two different scenarios. So pulling up the next slide here, this is a very, very basic snapshot. These numbers have been pulled from like a TD mortgage calculator online. Please, I am not a mortgage broker, everybody out there. This is just very simple calculations just to showcase this as a case study. All right.
We are not getting into the minutia of land transfer taxes
and commissions and all that stuff. Exactly. Property taxes, maintenance fees, all of that stuff. This is just a simple case study just to showcase these two scenarios. So again, here we're just looking at detached homes and we're breaking down, okay, you purchased at the height of the market. You purchased in February 2022. You bought a detached home for just over $2 million versus purchasing at the low end of the market. You got your detached home for just over $1.6 million, but your interest rate was 7.2%. Okay? So obviously properties over $1 million, you have to put 20% down. So here in this table, we're showcasing how much you're putting down for both property types, property prices. So if you purchased at just over $2 million, you're putting, oh my gosh, over $400,000 down, not including land transfer taxes. And if you purchased at the low end of the market at that 1.6 level, you put just over $300,000 down. So again, we're highlighting what your mortgage amounts would be and then your interest rate environment. So we're comparing 2.45% versus 7.2%. And we just did this
in such a short period of time.
The shortest.
It's unbelievable.
I know. These are based on 5-year fixed and a 30-year AM. And we'll talk about the fact that, yes, we know some people are on variables. I'm just getting ready for people to freak out about this. Some people are going to be on variables. Some people are going to be in different parts of their terms, all these different things. But again, this is just to showcase two different scenarios. So look at the difference between your monthly mortgage payments versus, somebody buying at the height versus somebody buying at high interest rate environments. You're looking at, what is that? Just over $2,000 spread, $2,400 spread. And look at the difference between how much interest you've paid at the end of your 5-year term between these two scenarios. Like that just blows my mind. So I think a lot of people are going to feel that they are winning because they purchased their home for $400,000 less than the peak. But then if you look at lifestyle and monthly overhead and interest paid out over a 5-year period, who really is ahead here?
Especially because you're only down on paper. You're not actually down until you sell the property. And it's one of the things that you have to remember is that you live in your payments. You don't live in your purchase price.
I think people forget that a lot. And so a lot of people who purchased at the peak of the market are not even in a position to sell yet, nor were likely planning to sell in the next 5 years when they acquired the property anyways. So when people are buying in this category, it's usually like a 5 or 10-year plan before they make their next step up the property ladder. So even if that's you and you're like, oh my God, I bought at the peak, you might be like nicely tucked in and locked in at a 2.5% interest rate, which wouldn't even be coming to term for another 3 years anyways. So don't feel bad about it, I guess is my point. I don't want people to feel bad.
Yeah, as the majority of your payments are going towards your principal and as you are in a much better monthly cash flow position than somebody else. And so if you believe that we have bottomed out, which is what the data is showing us, and if you believe that interest rates are going to continue to come down, which is what the economy is telling us, then hold on. And again, this is another misnomer. We are telling everybody if they don't have to sell, not to sell at the bottom or close to the bottom of the market and hold on, because this is going to pass over time.
Exactly. So we're going to do this 2 more times. One's just a quick snapshot of semi-detached. It's a very similar story. And then with condos, which is just really interesting because that's a whole other category in terms of how things are performing. Okay, so semi-detached houses at the peak, they were selling just over 1.5 million. And this all happened in March 2022. Interest rates were at 2.7. Peak of activity was around that period as well. Transactions moving through the system. The prices were at their lowest again at January 25th, 2023, or January 2023, not specifically that date. And the prime rate was at 6.7%. So if you purchased at the peak, prices have decreased in value. Again, this is just on paper by 18%. And there have been 48 less transactions in this category since that market peak in March 2022. However, if you purchased a semi-detached house 5 years ago in July 2019, prices are up 27%. And if you purchased a semi-detached home 10 years ago, and I remember showing properties 10 years ago when prices were at that level, prices are up almost 100% in this category. So we again did the exercise, forecasted recovery to peak. How long would that take? Let's estimate very modestly at 5% growth per year. Again, it would take about 4 years for the market to bounce back to its peak. However, we also know this category is really popular because this is really like the entry level price point for your second time buyer, those people moving from their condo into a house, or people who have access to the bank of mom and dad and they're just graduating directly as a first-time home buyer into this category. So I would say out of all the categories out there, the semi-detached house between 1.1 and 1.5 million is the most competitive of all the categories. So I would say at 5% a year, that's very, very modest. And I would say this would probably be a much more aggressive recovery period. Anyone to add to that, Ralph?
No, I just think it's interesting how both in detached and semi-detached, it looks like the bottom of the market was December and January 2022, December, January, and January 2023. And they're both showing a trend line from a price perspective and a transaction perspective of that being the absolute worst or the best time to have bought in the market had you bought then. But clearly the numbers are rebounding. And I think, again, it's very interest rate dependent, as the numbers will tell you. And so that could give you some indication of how to forecast in the future where the market will be. And I think especially in the low rise, meaning detached, semi-detached row houses, 5%, especially in year 3 and year 4, is going to be extremely, extremely conservative for where the market could be in a few years' time from now.
All right. So then we did the same exercise for just comparing the two environments. You purchased at the height of the market at the lowest rates, or you purchased at the low of the market, but at the height of the rates. That is a mouthful to say. So we're comparing purchasing at 1.5 versus 1.2. We're going through the same exercise with your down payment, your mortgage amount, same interest rate, being a 5-year fixed and the 30-year AM. What do those two monthly payments look like? And if you purchased at the peak, you're paying about $5,000 per month at a lower rate. But if you purchased at the bottom at the higher rate, your monthly payments are about $6,700 plus. And then you compare how much interest you've paid at the end of your 5-year term, and you've 3x'd if you purchased at the higher interest rate environment. It's just so interesting to me to see this. And again, for those people who purchased at the height and are like, oh my God, what did I do? Just take a look at this or screenshot this and just put this under your pillow at night just to make yourself feel a little bit better. Like you're going to be just fine. Anything here you want to add, Ralph?
No, I think if you'd bought on a variable during this time frame, you might have a bit of a different feeling for sure.
Yep.
But I think that there are people who have gotten ahead who bought at the height of the market. And over time, if they just hold on and don't sell, again, contrary to what most agents theoretically would tell you, but if you just hold on, the numbers, even when we get into condos, will show that we bottomed out December 2022, January 2023. And as interest rates come down, there will be a bounce back over time, not immediate, but over time in the market. So hold on, better times are coming. And all of the market data supports this narrative, not what you see in the media. And that's why this isn't readily available perspective, but that's why we've really gone out of our way to show this perspective from data as to what has happened from the peak to the bottom. And it's clear that we're starting on the path of a mild recovery.
So question for you, because I know people are going to be like, well, what about those people who need to refinance? They're so screwed. How would you respond to that, Ralph?
I'd say get a variable and ride the rates down. And most people who bought back in 2021, 2020, 2019, they were stress tested, meaning that they were buying approved at 2% above the rate with which they locked in. So you may have to think about, if you're tight, cutting back on other aspects of your discretionary spending in order to get through this period, but this will pass. And so just hold on. There are tough times that we all have to go through. This is one of them. And if you can't and you have to make a move, then it would consider a lot of thought into how you navigate through this market. But if you can't and you can lock in and you can just hold on, that would be our recommendation, and to get on a variable and ride this down. Because I think the whole higher for longer narrative, if you look at what's happening in the US and you look at what's happening here in Canada, from employment to real GDP per capita to where the Canadian economy is relative to other economies around the world and in the G7, you'll understand that rates are going to have to come down. And I still think if you look at COVID as an indication of how the market performed, you'll see upper middle class and upper middle class being in a better position when rates come down than the lower class. And I think it's going to be the lower aspects of the economy, people who participate in the lower end of the economy, who are going to struggle the longest. But I do think you'll see a rebound with the mid to high income earners as rates start to come down and discretionary spending starts to open up again.
Couple things there. We have definitely been riding the waves of the variable because both of us have properties and they're variables. And I just want to say that it's not like we've spent a month in Greece this summer, for example.
No.
Nor any summer for that matter. I'm just saying it's like we've been very smart about that and been like,
thank you for reminding me of that, Kori, because in my mind, I was like saying, oh, yeah, well, people are going to listen to this and think, wow, that's easy for you to say. We have multiple properties all on variables, and we have been very judicious with our spending, not selling, not panic selling, not riding this emotional sort of roller coaster.
Well, there's been a little bit of emotion.
Well, a little bit, some more than others. But we know that we're going to get through this, and that would be our best advice because it's what we're doing as active day-to-day market participants.
Exactly. And then the other piece to this, knowing somebody.
Maybe can we go to Greece next year?
Maybe. That would be amazing. And then my other point here is people are going to be like, well, I just don't believe in your growth projections because wages just aren't going up at that pace. How would you respond to that?
I'd say what's changed is the expectation of the way people live. And when you look at any major city around the world, people do live in 400, 500, 600 square foot properties. And I think once things start to change from an interest rates perspective, you'll see first-time buyers jumping back into the market. And what you'll see is those smaller units, which have been now sitting on the condo side, and we're going to talk about condos, start to actually perform the way they were anticipated to perform, with first-time buyers actually getting back into the market and getting out of their parents' basement. And so I think that's a real important thing to understand as the market slowly, especially on the condo side, starts to shift again. And it's people do want to continue to own Toronto real estate. It's just a question of can and how. And over time, that can and how is going to open up. And over time, when we start to talk about our projections about the condo market, if you're watching this, you have to understand that while we're suffering from high interest rates, if you're looking to buy or you own real estate in the market, that has basically decimated the development and pre-construction industry. And there is next to no properties coming down the pipeline in 3, 4, and 5 years. And that is going to have a dramatic effect on pricing in the condo market, which in turn is going to affect the low-rise resale market. This is all going to take time to play out, but over time, if you just look at supply and demand, the picture will become very, very clear.
I agree. Great answers. Thank you for your perspective, as always.
Thank you for your questions.
All right. So let's look at condos, speaking of which is actually very interesting and surprised even me, who looks at these numbers all the time. So again, in yellow, we're looking at peak of the market for price, peak of the market in terms of transactions moving through the system. So the highest average condo price was in March 2022 at just over $830,000. with over 2,000 transactions transpiring that month when interest rates were at 2.7%. Then we go to what we're calling the bottom. And again, this isn't highlighting every single month. We're just highlighting the months where we've seen interest rate changes. Was in January 2023. We're seeing a pattern here. Ralph, I'm not sure if you're tracking that as well. The bottom or the lowest average condo sale price, just over $700,000. And the lowest transactions, I don't think I highlighted here, looks like they were that month as well. So
yeah, 604.
604. Mm-hmm. So surprisingly to me, like honestly, I was like, this isn't as dramatic as I expected, considering how much condo inventory is actually out there right now and how much we're just constantly seeing that the Toronto condo market is crashing and it's just horrible and people are like defaulting. The news is negative and I personally get sucked into it too. So it's not just you people. And so we've seen definitely a price correction, about 10% decreased value year to date in comparison to March 2022 and 50% less transactions. All right. So we know, we're acknowledging high inventory. Not a lot of people are buying condos right now. There's less activity. There's less buzz. Things are sitting. Lots of them are tenanted. Investors are trying to sell. We're in a stalemate when it comes to this. So completely acknowledging this. However, if you purchased a condo 5 years ago, prices are still up 19%. That's pretty amazing to me, considering everything that happened with COVID and then all these taxes and policies as well that we've highlighted in gray font here. And then if you purchased your condo 10 years ago, you're up almost 100% in value. 100%. Incredible.
And it's one of the things, again, when you're talking about residential real estate, theoretically, you're leveraged. So on a condo under $1 million, you could be putting down as little as 10%. On above $1 million, you're putting 20%. So if you buy something for $1 million and you put down $200,000 and it goes to $2 million, that profit is all tax free
for now.
So yeah, exactly, for now. Hopefully it will continue to stay that way. There's an election coming up. We just one more year
and 2 months or something.
Yeah, not saying who I'm going to vote for, but if you're watching this, you can make your own observations. When you understand the power of leverage and the fact that this asset class is tax-free and that you're still paying down your own mortgage principal versus someone else's rent, there still is a really good story for how the market has performed in the worst possible circumstances that you could ever imagine. A tsunami basically hitting the market on all fronts, and yet it's performed, and your investment, no matter how you look at it, still has performed very, very well.
And I just want to say, because I know somebody's going to say it, you might have done better in the stock market, or you might have done better if you bought Bitcoin or crypto or whatever. There's other things that we're totally saying that might have performed better than this. We're just
and to anybody watching, I'll still push back on saying that if you bought the SP 500 or whatever, S&P 500, you actually have ended up better than had you bought real estate in Toronto. I just don't think the numbers support that. And that's maybe a whole other podcast. I think the only thing that really has outperformed Toronto real estate over the last 5 or 10 years has been Bitcoin. That's my personal opinion, but I'm happy to hear whoever's got any other opinions on that.
Bring it, bring it, bring it. Okay.
No, don't say that.
Okay. So I think that our forecasted recovery to peak is really wise. I like what we did here. So we're like, there's going to be no appreciation in condos next year. We just have too much inventory out there to sell through.
Yeah, and it could be 2 years.
Yeah.
It literally could. Is the market going to go down to nothing? We've already shown on multiple asset classes that we've experienced the bottom. Could we flatline? Could it be soft for a while? Could we go down a little bit? Sure. But the bottom, it seems like we are past, especially acknowledging we've already seen 2 cuts and there are multiple cuts yet to come.
Exactly. So we did 0% for year 1, as you can see here in purple font. Then we're like maybe 3% in year 2, but again, that could be 0. And then we're like, okay, it's going to start there'll be an uptick, especially when we move through this current supply that's currently on the market. People come back into the market. Interest rates are a lot healthier. People feel a little bit more confident about what's going on. And then we're going to start increasing our growth trajectory to 5%. So again, here we're like, it's going to take a good 4 years for this asset class to bounce back to market peak. Maybe a little bit slower, maybe a little bit faster, but 4 years. I seriously feel like that is like a manageable amount of time.
Mm-hmm.
Again, if we were saying like 10, 15 years, I would have more of that niggle in my stomach, but that does not freak me out.
No. And again, talking about supply and demand, if you understand the problems that we are going to be facing in the pipeline in a few years' time, 5% will seem very, very low based on the data and the information that's out there.
Okay, so we're going to quickly just do our case study on condos and also acknowledging that you don't need to put a full 20% down on condos less than $1 million, but just to keep apples to apples on all of these case studies, I kept it at a 20% down payment, okay? But the requirements under $1 million is 5% for the first 500,000 and then 10% for the portion remaining up to $1 million, just so you're clear about that we know what we're talking about when it comes to that. All right, so you purchased your purchase price at the height of the market when interest rates are at 2.7% for $831 versus purchasing at the height of the interest rate environment for $753,000. Okay, that's what we're comparing. I've got your 2 down payments here, which are very similar, your mortgage amounts, and then we're comparing these interest rates, 2.7% versus 7.2%. And then look at the difference in the monthly mortgage payments. So $2,700 versus just over $4,000. Crazy. Like that's a huge difference. I mean, huge. What first-time home buyer too is going to want to be like paying $4,000 a month?
No, they're going to stay in their paid parents' basement and they're going to keep saving.
Or they're going to rent for $2,400 a month.
Exactly.
And this is why we're in the situation we're in, where everything's just sitting. Like the numbers just don't make sense. And then you look at the interest paid at the end of a 5-year term, $84,000 compared to just over $200,000 in interest.
It's unbelievable.
It really is. So again, I think this is just a very interesting thing to compare and to give people a peace of mind, some peace of mind. If they're like, oh my God, I bought my condo right at the height. Like, why didn't I wait? If you're locked in at your 2.7% or around there, you're going to be just fine. You're going to be just fine.
And there's no impending calamity coming in the market. It may be soft for a while, but just if you own, there's no point in selling now. Just hold on. And a year from now, we could be, and most likely will be, in a very different scenario.
Yes. Okay, briefly, I just want to go over these last 2 slides. I just think they're interesting. We pulled all the active listings on the market since the peak, March 2022, up until July last month, 2024. And then these red stars indicate when there's been an interest rate increase. And then the green stars indicate when there's an interest rate cut. And you can just see, I just think it's interesting when you see things visually that slowly there's just been more active listings coming on the market as we've seen this interest rate environment change. So more things are on the market, but not selling at the rate that we've seen the pace or the velocity of the market in the past. And then finally, I think this is very interesting. This is the same time frame and then the same idea of highlighting when the interest rate increases took place versus the decreases from the peak to now. And you can see inventory levels increasing. So more people are looking to sell or, sorry, what are you going to say, Ralph?
Well, I was going to say, if you look at this chart, and it's one of the things you could feel that was palpable in the market, it was those two final increases in June and July 2023 that really put the market on ice. You could see that throughout all of the interest rate increases, there was climbing inventory. We seem to have flatlined and reached some type of a homeostasis. I'm really proud of myself for using that term.
Me too.
And it seemed like we were in a sort of balanced environment. And it was those two increases that basically just shot everything straight up. It felt like things had started to stabilize around that time. And those two rate increases were the ones, in my opinion, that really put the market over the edge. And now we've seen those two increases erased. Now we've had a lot of mortgages rolling over between then and now. So it's probably going to take some more time for this to work its way through the system. But it's interesting to sort of see on a timeline how this all played out.
Yeah. Very, very interesting. Well, I'm so glad that we carved out time to pull all of this together. I actually personally found it informative. Ralph, I hope you did as well. And viewers, I hope you did learn something from this.
Yeah, I think it's really helpful to see all this play out on a timeline relative to interest rates. And it's really helpful because when you read an article in the paper or you watch some content online, they're generally pushing a narrative with very small snippets of information. And a lot of it is just based on fear. And for me, and I think for yourself as well, Kori, not just being real estate agents and owning a brokerage and participating in the market every day, but owning our own real estate portfolio, it's still very reassuring to see all of this information just spread out over a timeline on a chart. And you start to actually can come to your own conclusions based on real data. And if you think the market, or you hope the market is still going to crash and the economy crashes and we all end up living in bunkers and eating bugs, like that's your own prerogative. And we're happy to hear why you think that, or if you think that there have been better investments or will continue to be better investments over time. That's fine as well. We really welcome other opinions and ideas about what's happening in the market. But for us as active participants and owners, it's really reassuring, and it's reassuring to be able to share this information with our clients and to anybody who's interested in tuning in today. So I think we were really happy to have shared this information, and it's great to have had everybody join us today.
So appreciative. Well, thank you so much for joining us. Again, we welcome all your comments below. Feel free to like, subscribe, and set up your notifications for more content like this. And we look forward to catching up with you next week.
Awesome.
Thanks, everybody. Thanks for tuning in.
Bye-bye.
Bye.